Hey, what's up, everybody? It's Caleb from thebookflipper.com. I'm here with my good friend Chris Winans. Chris, say hello.
Hey, how are you guys?
So this is part dos, and we did Accounting 101 last Thursday, I believe. So you can check that out. You can search in our channel on YouTube or in Facebook, and you can look up for Accounting 101, and that will pop up if you want to get a little bit of a background into what we're doing today. This is going to be the funnest, most funnerest portion of accounting. Today, we are talking all about deductions. So we all know Sherlock Holmes said brilliant deduction, although it was actually induction, but again, I digress. So without further ado, we're going to jump in. I'm having a bit of technical difficulties. I was trying to get my iPad. A couple of you asked. I had sketchy sketches showing last time, and all that was the name of my notebook in, I think it's called Good Notes. So it's just an iPad with a pencil, but for some reason it doesn't like my computer tonight. So I'm going to keep tinkering as we talk, and hopefully we'll get that to work. Otherwise, we will just be looking at our ugly mugs, and we can draw some things later. So Chris, while I'm tinkering just a few more times before this maybe just falls apart, do you want to give just a quick recap about having a separate bank account from last time, and then we will jump right into deductions?
Yeah, one of the things that is the cause of more complexity than is needed when I meet a client is kind of the commingling of funds, is what we term it in the accounting world. So that's one bank account where you have both personal and business expenses. So if I can provide any advice for anybody who's starting out or running a business, it's, man, keep them separate. The easiest way to accomplish that is to have a completely separate business account. Business income runs into that. Business expenses run out of that. And then any transfers or any personal transactions that occur there are very clearly marked so they don't get lumped in with the rest of the income and the expenses there.
Perfect. So all things separate. That's going to be the best kicker. We're going to get into some of the advanced sections as it relates to LLC versus S Corp versus employees versus sales tax. That's going to be part 3, and that's going to be coming out next week. So stay tuned for accounting part 3. I think we're calling it 201. But for today, we're going to hone in, and I'm hoping I can still get this pencil to work. But if we can't, we're just going to talk, and maybe we can add some cool illustrations to the screen at a later point in time. So today we're going to be talking about deductions. And the main thing as it relates to deductions, first off, let's 30,000 foot view. What's the difference between a deduction and a credit? Because that's an important distinction.
Yeah. So again, it's pluses and minuses in the accounting world. Income comes in, right, and that makes your bank account balance go up. Expenses come out, deductions occur, the bank balance goes down, right? So just the really simple ins and outs, pluses and minuses across the board.
Perfect. So one thing that it's worth noting is as it relates to a credit. So if you get a credit on your taxes, that is a dollar for dollar deduction or removal of what you owe on the tax, right? So let's say you get to the end of the year and you owe $5,000 in taxes. If you qualify for a $500 credit for some reason, whether it's education or energy, that would actually reduce dollar for dollar the amount of taxes that you owe by $500. When it comes to deductions, it's not quite as good. And so a deduction, remember we talked about last week that typically you're going to be roughly in the 1/3 of your income or your taxable income is going to go toward taxes. So when you have a qualified deduction, which we'll talk about what that means today, that deduction of $500 actually only saves you 1/3 of what you were going to spend on taxes. Is that correct, Chris?
Yeah, that's right. So yeah, my misunderstanding of credits and deductions there. Yeah, tax credits, there's 2 different types. There's a fully refundable tax credit and there's a non-refundable tax credit that occurs. And that takes your tax balance, your total tax due, and if it'll take you down to 0 if it's a non-refundable credit, it'll actually take you below 0 if it's a fully refundable credit. And that's a dollar for dollar tax change versus just reducing your taxable income and then doing the math that's necessary to calculate tax.
Exactly. So what that means net, I've got a buddy, I'll throw him under the bus. His name's Sean. He's a good friend of mine. He for a while ran a photography business, and he's always doing something in the entrepreneurial world. But we would go out for drinks and hang out with, some business guys or even sometimes non-business guys. But we would talk business, over the meal, and then it would come time for the bill, and we're all pulling out, hey, let's split this, 3-4 ways. And he would just pull out his business card and go, hey guys, I got this. It's a deduction. It's a write-off, right? And I'd be like, Sean, you realize that, one, let's assume it's a business dinner, so it is, you can write it off. But two, it's a deduction. So if it's $100 dinner for 5 people at McDonald's, right? If it's $100 dinner, you're only saving $33 on taxes. $67 still came out of your pocket. And he's like, oh, nah, it's a write-off. So just understand that deductions, the goal is not to maximize deductions. The goal is to make money in your business, and deductions help you pay the right amount of tax and not overpay. So 2 schools of thoughts when it comes to deductions. One is that's scary. I don't want to get audited by the IRS. And so I'm gonna stay way over here on the conservative side and not deduct anything, or just the bare essentials. On the other end of the spectrum is, man, I hate paying taxes. I refuse to do it. I'm going to try and just hide or shelter every last dollar in my business. And I'm going to try and deduct everything, even if it's not even remotely business oriented. Well, the correct answer, as it is in most areas of life, is somewhere in between. So we're going to talk through that tonight. The main purpose of the deductions is say, hey, you made X amount of dollars. You had qualified things, so parts of your business that were required for booksellers. We'll get into what that means. And then you owe what that number is, and that's what you pay taxes on. So let's start with some of the easy ones, and then I've got a couple categories we'll talk through. I still didn't get this pencil to work, so I think we're just going to abandon. And unfortunately, I don't know what's going on. At least I didn't reboot my computer before this time.
Yeah, we started on time. So
yeah, you know what? 2 out of 3, and I guess this is just proof that I'm getting old, that my technology no longer works for me, and so it is what it is. So let's start talking through. I guess I could try one more cable, but I don't think it's a cable issue. All right, we're gonna abandon it. It was fun while it lasted. So we're just gonna chat. All right, okay. So as it relates to deductions, let's talk first the really simple one. So anything that is 100% used for business, supplies, etc., is going to be deductible. So what does that mean? That means all the tape you buy, the boxes you purchase to send into FBA, the labels, the label printer, the equipment, computers. We'll talk about big purchases in a second. All of those things are obviously 100% used in the business, therefore you get to deduct them. So that's a pretty simple one. Anything else that kind of falls into that category, Chris?
Really, it's a very, very broad category. It's anything that is used in the pursuit of revenue. That's a business expense. And so there are little subcategories in there that have either a partial deduction component, or they have to be reported and deducted a different way, right? Or capital expenses and the like. But really, anything in pursuit of revenue related to a business is a business expense.
Perfect. So it starts to get a little hairy when we talk about things that can be used for both business and personal, right? And it starts to get a little hairy as we get into travel and meals and inventory. So let's tackle those just one by one. Guys, for the format, if you're watching, feel free to say, hey, let us know where you're watching from. We've got some people on Facebook that are watching. I know we've got some people on YouTube as well. And this will be recorded. So if you do have to drop off, or you find us crazily unentertaining for whatever reason, you can certainly watch us back at 2 or 3x on your own time. So, but drop us a line. Let us know where you're from, what you're doing right now, hopefully business related or enjoying some food. And we'll get through these deductions as well. And then we will take time for your questions at the end. So if you do have specific questions that we don't cover, by all means, drop those in the chat. I'll be keeping an eye. We'll pick off a few of them throughout the night, and then we'll definitely have a Q&A at the end. So we've got Tom and Mary and Brian, and somebody says they're from Lancaster, Pennsylvania. I used to think it was Lancaster, but I'm well aware now it's Lancaster. So all right, so anything that's obviously used 100% for business, that's great. What about when we start getting to some of the grayer areas, like this MacBook that I'm on? Obviously, I use this a little bit for personal, and it's mostly for business. What's the general rules on items that can be used both ways?
So the most right way is to split it, right? And ultimately, if it's your MacBook and you use it half for personal and half for business, great. Split it accordingly. and then you get to deduct or depreciate half of that expense. Same goes for your vehicle, right? And a lot of things. So this mixed use stuff, it's ugly, it's not clean, but it's just life, and so ultimately, uh, there's a happy medium that has to be put into place. Otherwise, we'd be tracking the use of every single thing all the time. If you're into the 80-90% range, it's a business resource, and we will treat it as such.
Perfect. So when it comes to your business accounts and your financials, obviously we want all of that separated. Unfortunately, when we start getting into personal use items slash mixed use items slash business items, it does become a little bit more hairy. And while in a perfect world, you would have a computer that you use at home, you buy a separate laptop that's 100% used for business. That's kind of silly, right? I don't need, two MacBooks floating around, one at home, one at the office. That's really just not practical. So the general rule, so how do we document this, right? Obviously, it's going to raise red flags if every mixed use asset, I'm saying, hey, it's 99% work and 1% personal to try and maximize deductions, right? That looks poor. So does the IRS actually dig that deeply into it? Should we just roughly estimate? Is there how should we be tracking this?
Yeah, I mean, the IRS doesn't dig that deep until they do. And you've got to give them a reason to, right? So it's prudent man or prudent person tracking, right? Your laptop is a business expense. It is. And I know that you use it for some personal stuff, but I have multiple computers in my office here. It's a business office, and I still use these for personal, right? I'm looking at the internet or Facebook or something. So it's just a prudent man use, and you just move forward from there. Don't make it more difficult than it needs to be in that sense.
Exactly. So should I at least have some kind of records? I know that you kind of encourage me to have records or say, hey, this is a specific asset and it's 80% business, 20% personal. Is it nice to write things down just so if they come knocking, you go, hey, here's roughly my usage, and here we go.
Yeah, and those are really important. Cell phone's a great example of that. It's like, listen, my phone is about 90% business use, and I can justify that because I've got my VoIP phone that I use on my cell phone, and that's 90% of my use. Then I've got my personal phone that I text my wife and like the two friends that I have, and so that's the rest of my use. And so as long as there's something to fall back on that says, look, this is what I use it for, you're good. Cars the same way. Track your mileage, same way.
Yep. And don't get too hung up on this, everybody. One, we're just trying to help you understand that, your phone, if you're using that a lot for work, your computer, some of these other assets that you have to have anyway, if you run a side business, especially if that business is taking up a good chunk of your time, don't be afraid to allocate a percentage of that and say, look, I'm using it for business. I couldn't do the business without it. And that's certainly an area that you can deduct.
Yeah, don't leave money on the table. I guess that's the most important thing. Use tax code to your advantage. It's in there. We're not making any of this up. We're not manipulating anything. It's not sketchy. It's not anything. These rules were given to you. Use them all accordingly.
Perfect. I am going to grab one more cable. I'm not giving up on this. I know I said
really
I did.
Bothering you.
It is. I'm going to do that way. So I'm going to tee you up with another question on travel, and I'd like you to talk through the mileage deduction, what that means, because there's two different ways you can track your vehicle expenses. One, you can just track every single expense and take a percentage that's applied to business, or there's this beautiful mileage deduction. So why don't you talk through that for just a moment, and I'll be right back.
Sounds good. So guys, the mileage deduction is kind of a catch-all given by the IRS, and it oscillates year over year between 53 cents, 56 cents, 58 cents. It depends. But what's captured within there is an average amount of gas, maintenance, wear and tear, and then some depreciation as well. And so you track your business mileage accordingly. And it's, for round figure's sake, 55 cents a mile. And all of your business miles multiplied by that 55 cents, and you get to deduct that business travel off of the income that you make at the end of the year. It goes right on the spot on your tax return. The other way you can do this is by tracking literal expenses, right? So that's tracking all of your gas. That's tracking oil changes. It's tracking any repairs. And Then we take a percentage of that and we allocate it to, again, business and personal. And you get to claim the deductions associated with the business side of those literal expenses. On top of that, you get to depreciate a vehicle if it is a business vehicle used primarily for business. If it's a personal car, you don't get to put that on the list of assets for the business. And in that case, I would suggest that you take more of a mileage deduction than anything else. One of the other things to think about as we're, oh, good, thank God you're back, too.
I was just going to see how long you'd go.
Yeah, it was gonna get ugly. So,
well, it's still not working. So, given those two choices between trying to track all the individual expenses and just doing the mileage rate is significantly easier. So
yeah,
that is.
and these things are great. You get Mile IQ or something that just sits on your phone and it runs in the background all the time. And at the end of the week, end of the month, at the end of the year, if you're really brave, you can go through and swipe left or swipe right for business versus personal use, and it spits out a nice, pretty report and says, "All right, your business miles were this, and this is the deduction that you get as a result."
Exactly, and I use Mile IQ. Of course, I use anything with the words IQ in it. Just that's kind of what we do, Scout IQ, etc. But I love it. It's just always running on the phone. It doesn't really chew into the battery too much, and if I won't get too personal, but if you're sitting on the toilet, you can open Mile IQ, and instead of looking at TikTok videos, you can swipe personal and business mileage. So there's a pro tip. You can also just set a calendar invite once a week, just part of your weekly rhythm as you're game planning for the week ahead. Just have that as part of your routine. What you don't want to do is get 3 months down the road and forget, oh my goodness, I went to Ohio, what was that for? Or I drove down the street over here, what was that for? So just do it while it's fresh. And it keeps a nice log. You can even store addresses in Mile IQ. So you could say, this is my office, this is my home, this is Goodwill number 1. And so it's really easy just to remember, and it creates a nice log that the IRS will accept to take those deductions. Mm-hmm. Let's talk about home office. So many of us don't have the luxury of having a real office. If we did have a real office, obviously you're typically paying a lease or some sort of a rent. All of that's going to be deductible, assuming it's 100% business. What about home? So most of us work from home. What kind of deductions can we get there, if any, as it relates to small business?
Yeah, so this is, again, one of those mixed use conversations. Really important, well, less important now than it used to be. This used to be the perfect auditor's focus because it was really easy. You'd go into somebody's house and they're like, all right, you took a home office deduction, show me your home office. But, well, it's my kitchen table. They're like, well, we reject that, pay us up, and then we need penalties and interest on top of it.
Because you were supposed to have a separate area of your house dedicated 100% to business, right?
Yeah, and it's called exclusive use. And so the IRS wants a room or an area that is specifically dedicated to business. It's not used for any sort of personal use whatsoever. It's your office. And that's still how it's defined. They've really lightened up on the audit red flags tied to home office because they've created this sort of standard deduction equivalent for a home office. It's X number of dollars per square foot, and it's just a fixed rate. So again, you can kind of take the same approach with the home office as you would with your vehicle. It's either the mileage rate or the literal expenses. You can take just a fixed standard square foot rate, or you can take literal expenses with your home office. And so tracking, if you painted the house and your home office takes up 10% of the house, well, you can deduct 10% because that was an improvement on the business aspect of that home office. It's a lot easier really just to take a square footage and take that fixed rate and be done with it, unless there's a really significant improvement truly allocated to the home office.
Yeah, so the good news is they're actually, the IRS is being reasonable and creating some mechanisms where it's simple. Mileage rate on your car, you don't have to track oil changes and repairs and everything else and depreciation. And then just a standard home office deduction based on your home. So again, talk to a CPA, somebody that's good with numbers, someone that knows exactly what the rules are and understands your situation. sometimes it may make sense to do these slightly differently. And that's essentially what you're paying a good CPA to do. And if it makes sense, it'll save you money on taxes and reduce essentially what you're paying the CPA. Again, a good CPA, a good lawyer should pay for themselves. So, and Chris does many times over for me. So that's a good testament there. All right, let's talk traveling. So there's two kinds of traveling. And again, I wish I could draw, but I'm hampered. We're just going to have to do things.
Just don't know what to do with your hands.
Yeah, exactly. So there's two types of traveling. One is going to be like just local sourcing trips. So I'm out for a day. I'm going to source half the day. I'm going to have some meals. Of course, I'm driving. I'm going to buy some supplies along the way, and I'm going to buy some inventory. So let's talk through that portion, and then let's talk through like overnight trips or longer trips.
Sounds good. So start your day with a full tank of gas, right? You're going to drive for an hour or two. You stop by Starbucks on the way out there. You're going to grab lunch at McDonald's or Chick-fil-A, whatever you want. You stop at a couple of sourcing sites, maybe a Goodwill here, a thrift store there, and then you come home, right? And you end with a half a tank of gas. All right. So that full trip was a business trip. But those meals are not business meals. Right, you're a growing boy and you've got to eat, right? You just have to. The IRS takes the opinion that even if you're out doing business work, that doesn't mean it's a business lunch. And so those are personal meals, personal snacks, and everything else along the way. If you want to track the gas that you spent, it's half a tank of gas, and you can clearly identify that. You could just as easily track the mileage that goes with it.
Now, you're allowed to do both, correct? So if I'm going to pay myself back for gas, I can't do that and mileage.
Right. It's either or. Right. What we tell people to do is, if it's not too burdensome, track both, because it's always fun. And this is what we do with you, right? We'll optimize. I'll run the mileage numbers, and then I'll run your literal expenses, and we'll give you whatever is better and in your best interest. If you're only going to track one, track your mileage and be done with it. It just depends on your organization level and what you want to do.
Perfect. So mileage is really easy. Meals don't count. Now, let's say I'm sourcing with a business partner. So we run the same business together, whether that's a friend, a spouse, etc., and we go out for a meal. Is that all of a sudden a business meeting?
Maybe. And so not necessarily. There's ways to do this, right? And this is the gray area of all things accounting, right? Don't get greedy, right? Pigs eat, hogs get slaughtered, kind of a thing. And so ultimately, if you're sitting down and this is a strategy session, right? And you guys are sitting down to a meal, but man, you're cranking out business plans. You go here, I'm going to go here. These are the books that you're going to pursue, and this is your target market, and I'm going to go talk to these people and everything else. If it's a true business meeting, so be it. If this is a snack along the way, don't push it, guys. Come on.
Yeah. So for me, let's say I run into a Scout IQ customer in the field, and I'm like, oh my goodness, this is so cool. Let's go grab a bite to eat, and I take them out. Obviously, that's going to be a business deduction. That's actually a true business meeting. I'm taking a client out for a meal. Right. So be careful when it's like a business partner, a spouse, someone else that's actively involved in your business. Certainly a meal or two here and there. If you go out and say, hey, we're going to have a business meeting away and go out and have some food and do this once in a while, that's certainly acceptable. But as a general rule, especially if you're out sourcing all the time and trying to write off every last meal that you can, that's going to be an issue in the long run. So just be cautious there. All right. So what about mixed travel that's locally? So I'm driving half hour across town to see my friends. And then while I'm there, so non-business related, 100%. While I'm on the other side of town, I realize, oh, I actually need some boxes from Home Depot. There's a Home Depot right here. And I swing by the Home Depot and then I drive back home. Can all of a sudden that be a business write-off on the mileage, or is that pushing it as well?
I think that's pushing it. The IRS rules are your business mileage starts when you get to the office, right? And a lot of us work from home. So you can very easily articulate that this is a business trip. I left the office and I'm going to do something. But if you left the office to go see your friends and then along the way you picked up these things, just again, it's 55 cents a mile, right? It's not going to break the bank one way or the other. you can maybe articulate a certain percentage of that total trip as a business expense. Just don't get greedy.
Yeah, and probably a good rule of thumb is like when in doubt here, probably shouldn't. And again, those two ends of the spectrum, some of you are trying to deduct everything, and some of you are saying, well, I shouldn't deduct anything. I don't want to get in trouble. We're probably going to tell both of you, let's meet in the middle somewhere, right?
Yeah.
Let's move toward this middle ground.
Absolutely.
Cool. What about overnight sourcing? So let's say there's a library sale, 200 miles away, and it starts at 8 a.m. and I don't want to, drive 4 hours and have to leave my house at 3 in the morning. So I decided to drive to this location. Like it's pretty clear. It's not reasonable to get up at 3 a.m. and I'm going to drive there, eat a meal on the road for dinner, spend the night, go to the library sale, eat lunch, and come home. How does that get accounted? Is that any different than a local trip?
Yeah, so this is now a distance trip, right? And so the IRS defines it very specifically. I think it's over 70 miles still. I don't think they've changed that. But if you are a specific distance away from your home, now things completely change. And so now meals are potentially deductible up to a percentage. Lodging is a business expense. The travel is a business expense, and you can pay yourself almost an allowance just because you're away from home. So there's ordinary and necessary expenses that you can just automatically reimburse. It's called per diem, and it's a very specific IRS rate. And again, we're gonna put the caveat in there. It depends on the type of entity and how we structure it. We're talking macro level, just general concepts here. But there's a per diem rate that it's a travel allowance, both for meals, for lodging, and then incidental and necessary expenses along the way.
Yeah, and so again, the IRS usually has multiple ways to achieve a similar outcome. And so for miles, it's just taking, or for car use, it's taking the mileage expense. This was a new one. I think you explained this one to me about a year ago, and I'd never heard of it. And it's actually simplified my accounting tremendously, and that is the per diem. So for me, I believe most cities I go to is 170 bucks.
Yeah,
Right.
and I actually have a table up here. So there's different rates depending on the county or the city, right? And you almost have to look it up by the city to determine what your daily rate is for meals and for lodging. Some of those higher priced cities, right? New York City, San Francisco, and everything else. Those rates can actually get pretty high. I'm looking at DC right now, and it's broken down by month. But it's $258 per day for lodging.
Now, can I take a per diem if I have an LLC, or do I have to have like an S corp or something a little bit higher?
No, so the LLCs, sole proprietors, and everything else is really what this per diem is made for if you're the owner. We do things a little bit differently with the S corp side of things, especially if you are the owner employee. We talk about accountable plans and reimbursement through payroll and different means there. But the sweet spot for this value is the LLCs and the sole proprietors.
Perfect. So again, option A on a business trip that's, far enough away from home that, you actually have to be there overnight is you can actually write off the mileage. If you get a rental car, you can write that off as well. You can write off the food. It used to be 50% of the food because the IRS says you have to eat anyway. Now, part of the, I don't know if it's PPP, but part of the stimulus, it's now 100% write-offable for the next 2 years.
CARES Act. Yep.
Mm-hmm. So that's pretty cool. Again, it's a deduction. It's not a write-off, right? You're not saving your $20 Applebee's burger or whatever you're eating. You're saving a third or whatever your tax rate is on that cost. Right. So don't go too crazy. You're still paying the majority of it out of pocket, right? It's not free food. It's just a little bit different. So you can deduct your food, 100% of it, your miles, your hotel, and of course, whatever the inventory you buy. We'll talk about inventory in a minute. Or if you don't want to do that, you can simply say, I'm going to give myself a per diem. So I drove there, Friday night, the sale is Saturday morning, and I came back home. Now that's 2 different days. So you get 2 cracks at the per diem. Is that right?
Yeah. So the first and the last day, you kind of get a half rate because they're taking some of that in from a personal expense side of things. But these multi-day trips, if you're going to a high cost area and you're living on the cheap, right? Some of you guys are gifted at living on the cheap. you
Or Rome
can
or sleep in the car, right?
yeah, go live in your car. You can actually come out ahead with per diem in these instances, which is a nice added perk.
Yeah. So when I pay the per diem, let's just call it 170 bucks. Let's say it's a regular cost area. So let's say I eat really cheap, I get some ramen noodles, and then I sleep in my car. So I actually have, let's say my total cost for lodging and food is like, $6.
Sure.
Let's pretend, right? So
Yeah.
I can actually deduct $170 from my business, right? And that money that came to me as the employee side of the employer equation, do I have to pay tax on that 170?
No. So
So
it's your per diem bonus. It's your per diem.
So if you guys really, and this is, it's not a loophole. It's just the way that the system is written. If you can stay with a friend, if you can, sleep at a campground that doesn't cost much, you can still pay yourself that per diem. And again, we're not talking a life-changing amount of money. It's 170 bucks. You can save roughly a third of that depending on your average tax rate. So you're saving, 63 bucks or whatever that comes, 57-ish. Someone can check my math, but you're saving under 60 bucks, right? It's not a huge number that you're saving in the form of taxes, but that is certainly something you can do as it relates to travel.
Yeah, and I guess just remember all these little things add up, and so this can be a couple of $1,000s really quick in additional savings that if you're not listening to this or you're not talking with somebody and planning this stuff out, you're gonna miss, and that few $1,000s, right? You can reinvest in your business, buy some inventory, and maybe it turns into 10, right? There's a lot of opportunity here.
So if you're watching right now, pay attention. I can't take notes. You're gonna have to take your own notes. Guys and gals, hopefully this is actually gonna save you a chunk of money by watching this tonight. So you're welcome. Y'all can name your pets after Chris. You can whatever it is to pay homage to him.
That's
but
right.
Take notes. And again, it just comes back to understanding the way, I always refer to business as a game. And I know some of you don't think that's funny and whatever you take it very literally. Like it's a game, right? Like, sure, you're trying to put food on the table and everything else, but hopefully you're having fun with it. Hopefully you're figuring out ways to be creative and, play that game. So part of the game of business, as we talk about it, is understanding what the rules are, understanding where you can play, and then just setting that up in advance. And you guys know I talk about tracking things and making sure that you have a good system in place. If you don't have that and you get to the end of the year, and I often do this with Chris, I know I drive him crazy, but I get to the end of the year and I haven't really tracked everything as carefully as I should have. And then it's just a scramble, and it's stressful for me, it's stressful for him. And I know I'm missing out on deductions because, hey, that trip to Austin last year, I didn't really log it. So yeah, was it 4 days or 5? I guess I have to go find my plane, itinerary, see who I met with and which days count as business and which days don't. So the more you can just track it and stay up to speed with it, you're going to be just that much ahead. You'll have less stress and you'll have more in deductions, which means less money out of your pocket, more money in your pocket, rather, less out as well. And that's just more money you can put back into the business. All right, so that's travel. That's some general expenses as it relates to it. Let's talk about inventory next. This is a big one. So we see these questions a lot. We're going to talk about donations of inventory. So many of you think you can go and pick up a bunch of books for free at a garage sale after the fact and then donate them to Goodwill. And hey, the fair market value on books is $1 or $2 a piece because that's what Goodwill sells them for. And so of course I can write that off on my taxes. Chris, how do we actually account for write-offs when we're making donations? So we pull in a pile of books, we pull a few good books out, and we'll talk about bulk and Gaylords and whatever next. But we pull a couple good books out, and then we're donating the rest. Are we allowed to just say, hey, they're worth $1 a piece and write that off?
Sure. Whatever you do, you got to be consistent, right? And you don't get to double dip, and that's the problem. That's what a lot of people are trying to do. So let's use our example here. You've got 100 books, and you paid $100 for them. So you take them home, you sort them all out, and all right, I got 10 books that are good. So the rest, those 90 books, are worthless, right? In your mind, you've defined them as they're worthless. I'm going to give them away now or dispose of them in one form or fashion. Well, in that situation, you don't get to really deduct something that you definitively valued as worth zero. You don't get to claim it that way. And so what you did was you just changed the basis in your good books, right? Your inventory. So we can go two paths here. We bought 100 books for $100, and so our basis in each book is $1. Um, and I can keep 10, and I can dispose of the 90. I can claim a $90 deduction there, or I can keep the 10 and reassign my basis. So now each book has a basis of $10, and the other 90 have a basis of 0. And in that case, if I dispose of those 90, I don't get to claim that deduction. Ultimately, it comes out as a wash, whichever way you track it, because you're going to deduct it here, you're going to get a deduction when you sell it. But you can't double dip. Just don't double dip, because then that's going to blow everything up.
Yeah, and bottom line, if I'm interpreting that correctly, it's a closed loop system, right? So if I have $100 of buy costs, regardless of how I allocate it, and I dispose of some, sell some. Of course, Amazon doesn't sell all, so we remove those and dispose of them as well. At the end of the day, I can't deduct more than $100.
Right.
So for those of you running around picking up free books and then trying to offload them and say, hey, they're worth $1 or $2 a piece, you can't do that. If your cost basis is 0, then you don't get to count that. So that's key lesson number 1. Lesson number 2 is for those that do bulk, but instead of 100 books at a time, it's 1,000. It's a Gaylord box, 800 to 1,000 books, and that same principle applies. So let's say you bought a Gaylord. Let's say you paid 5 cents a pound, so $50, let's call it, for a Gaylord. Let's say it cost you another $50 to have it shipped to you, or someone dropped it off, right? So $50 of transportation, and then let's say, just for kicks and giggles, you paid someone $50, so your labor is $50. So now your total costs to generate good books from that Gaylord is $150. So again, there's probably a couple options here, right, Chris? Because that's the way the IRS works.
Yeah.
The best options, and what you generally want to do, is you want to accelerate costs. So the more costs that you can actually match up to what you're spending as your cash flow, the closer your taxable income comes to the actual cash in the bank, which is kind of what we're all after. What you don't want is to not have much cash in the bank at the end of the year, and you have a giant tax burden because of the way you did your accounting. You ideally want to marry those up. So am I right in the assumption that I could do one of two things? I could say it's $150 for these books, and so let's say I had a 15% keep rate and I kept 150 books. I could just say, hey, my total cost to get these good books was $1 a book. Is that accurate to say these are $1 a book?
Absolutely.
Could I also say, hey, I had to pay for freight regardless of whether they were good books or not. I had to pay for labor regardless. Could I actually expense those two components immediately?
Yeah, I think the conversation on what gets built into the basis of your books is up for debate. And you framed the question really well. I've got to pay for this anyway. This is a necessary and ordinary part of my business. It is a business expense that's not tied to any one specific piece of inventory. I just have to pay for this. So when it is an ordinary and necessary business expense, not tied directly to inventory, it's no longer basis, or what you guys would call COGS, cost of goods sold. It's just a deductible expense.
Perfect. And the only reason it matters, at the end of the day, when everything is sold and or disposed, your total expense that you're going to eventually write off is $150. Like, you're not going to get more than that by some, jujitsu with your accounting. The only reason it matters is, let's say I bought this Gaylord in December, and I run a regular ordinary year, and so my calendar schedule for taxes is January through December, and I do this on December 30th. I'm working right up until the end of the year, and I've got now $150 that are going to be applied to those books that I'm going to list. Well, let's say I signed the $150 as cost basis. So I said these 150 winners are all worth $1 a piece, and I list them. And by the time I list them, it's now January 1st, and they're going to be on next year's taxes. So if I didn't deduct anything at the end of the year, I don't get any tax savings on that $150 expense. So the only reason, and what you try and do, again, you have to have a reason for it, and you have to be consistent. You can't just switch around and say, well, my December accounting rules are going to accelerate expenses, right? Whatever you do has to just be consistent, right? And so what you would do then is, if you did the first method where you said, hey, the freight and the labor I had to do no matter what. And so you can expense $100 now and save that amount on taxes. So you can save that 33% of that. And then the $50 would be assigned as cost basis to the books. And as they sell, you would deduct that as well as cost of goods sold. Right. So that's the only reason for it. So when you can accelerate the expenses and when it makes sense to not apply it to cost of goods sold, that's a good idea. Because one thing you could do, let's say the IRS lets you just deduct inventory the moment you bought it, right? So the biggest rule in accounting, and especially what the IRS is after and what they teach you in Accounting 101, is called the matching principle. What we're trying to do is say, hey, I bought this, can of soda water or pop water if you're from Michigan or wherever, but I've got this, soda water, and I'm going to sell it on the street. So I buy it, I pay $1, and I'm going to sell it for $2, right? The idea is that you match that expense at the time the revenue is generated and shows up on your books. So if you're going to generate $2, you get to deduct the $1 at the moment that it's sold, and your profit is $1 minus other effort and labor and the cost of your cooler and ice and whatever else goes into generating that sale. What you can't do is get to the end of the year and go, hey, I had an awesome year and I have $63,000 of taxable income, and I'm going to pay a third of that. I'm going to pay $20,000 in taxes. What you can't do is go, I'm just going to go spend all the money in my bank. I'm going to go spend 60 grand on inventory on December 31st and just say, hey, I just spent all my profits and I owe 0 taxes, right? One, it's not a good idea because that's a waste of cash unless you got the mother lode of all books. But two, the IRS isn't going to smile upon that strategy. They want to get paid for what you actually generated during that year.
Right.
So that's a really key piece as it relates to inventory. So hopefully we answered some questions there. So we talked regular expenses. We talked your home. We talked about cars and travel and overnight trips and per diems. And then we got into inventory. I think we covered a lot of the bases. What else stands out that you see that gets missed or other common deductions we should look at? And then we're going to go ahead and take some questions. I think that's the bulk of the ones that are kind of a gray area for most of the people that I interact with. We've got the standard ones, right? Your Amazon seller fees and shipping costs and everything else that goes with that. Don't forget about those, right? And people, so print out your seller statements and let's take a look at these fees and make sure you're capturing all of those as well. Amazon takes a lot. And so if you're tracking gross income, right, gross sales, make sure you're deducting all of those accordingly so that you're not leaving money on the table. Yeah, and again, if you sell $100,000 worth of books, it depends on a lot of things, but the biggest lever is the average sale price on those books. If you're selling $100,000 of $10 books, Amazon's going to be eating up probably 75 to 80% of that total revenue in the form of fees. So you're only going to actually have 20 grand back in after Amazon, the Amazon machine chews up that revenue. 20 grand is now your taxable income less all of your deductions. So mileage and supplies and home office expense and all that. So you can quickly get to a very small number. Now, if you're selling more expensive books, $20 books, then Amazon's only eating up 40 to 50% of that cost in the form of fees. So again, you're not on the hook for 100 grand if you sold 100 grand. It's less all of the other expenses along the way from Amazon for sure. And so the way I do it is it kind of boils down to 3 buckets for me, maybe 4. I didn't think that went through before I said it. But I've got the tracking spreadsheet. And so I plug in everything I list. I put my cost of goods into the front end of that equation. You can do that with AccelerList, with ScanLister, with Inventory Lab. Doesn't really matter. It works with everything, right? So I apply my costs. And for cost, I'm not really worried about this book was 18 cents and this one was $12 and this one was $4.98. What I do is I take a bucket of books and say, hey, the total cost to me, I spent $300 and I have 300 books to show for it. It doesn't matter if some are cheap, some are expensive. I'm just going to apply an average cost. It's just way easier to handle and it just makes the accounting simpler. You can do either way. Again, just be consistent. So I have the costs there. Then I drop my sales reports in and it spits out exactly what Amazon's paying me. It actually backs out the cost of goods sold on everything that sold that year. And then all I have is I have a nice number. It generates an income statement. And all I have to do is add in my mileage, all of my software and supplies expenses that I have, and then anything else like business meals or whatever else. So that's really, it streamlines the process. So cost of goods sold, if you're not tracking it along the way, it can be somewhat difficult. And that's that whole accounting system. Again, it's a tracking spreadsheet. It's I think we can throw a fancy banner up here. That'll be fun. So the bookflipper.com/track. And again, I threw out a coupon code last time, but bonus 50, BONUS 50. And when you spend that money, it's $170 one time. You can get it for $120. It's a deduction because you're using that to manage your business. So it basically can save you between 25 and maybe 45%, depending on your tax bracket. So it won't cost you that much out of pocket, but it'll be 120. Use coupon code bonus 50, bonus 50, and you can have that, and it makes tracking a breeze. I plug my mileage in there once a month from MileIQ. I just transfer it over and just drop the number, and it gives me the amount I can deduct. And then I put my supplies in my software, and it's pretty simple to kind of keep everything separate from that standpoint. All right, we're gonna shift, and we're gonna take some questions from y'all. So we got a bunch of other people that said hello. So Jescu and Diane and Isaiah, and I'm gonna throw some questions up. And Chris, see if we can stump the expert. How's that?
Yeah.
Perfect. We're going to actually save this one. I'll throw it up here, Isaiah. We'll save this for part 3, which is coming up next week. He says, not quite deduction related, but is it allowable to have a SEP IRA for yourself with your business entity being a sole proprietor? If so, what's the maximum contribution? Kudos to you. You're already thinking retirement and savings. We will address that in part 3. So come back. Don't this one. That'll be our little hook. Facebook user. We got some weird names again. You guys need some real names. Can you deduct all miles if you're on a business road trip?
Yes.
That's pretty straightforward. Yep.
Yeah.
What if I stop by and see a friend while I'm happen to be on this business trip?
How far out of your way are you going, right? And so
Yeah.
if it's on the way and it's literally just there's no deviation, sure, it doesn't change anything, right? Again, don't get greedy, but track accordingly.
Well, and if you drive 300 miles round trip and then the portion that's outside your normal route is 10 of those miles, just say that's personal miles.
Right.
Right. So that's pretty straightforward. And traveling deduction, for me, I love to travel. I love the freedom that this business provides. I was trying to show a really cool view, but the sun is setting. I'm actually in Mexico right now visiting one of our clients who buys a lot of books from us. And we got a couple business people here doing a bit of a strategy session about how we're all growing our individual businesses. Well, there's certainly a portion of this that's for pleasure, and there's a portion that's for business. And so Chris and I have a good strategy, and we talk through those. But it's really nice, like, use those deductions. Don't shy away from it, right? I love to travel and meet people. It's part of the business. Sure, there's some personal benefit I derive, but come up with a good strategy because, otherwise I'm missing out on a lot of deductions. Another Facebook user, if I drive to the store or yard sale and do not find anything sourcing, so you struck out, we've all been there, can I still claim the miles?
Yeah.
Absolutely. So yeah, that's a bummer. You can claim the miles. You can, if you're overnight and still didn't get anything, that's all right. You don't want to do that too often. It probably raises a red flag if you, keep traveling and happen to visit concerts and friends and hit one well, right? Again, the purpose of this is to say, look, is this, 100% a business trip or, half and half? And in which case, come up with a strategy that accurately spreads those expenses out. Another Facebook user, we talked about this with per diem, but if we use a campground instead of a hotel, can we write off that expense? Certainly. And again, you could just use the per diem. And if you slept for free somewhere because you had a couch or a free car or slept under a bench somewhere, cool. You don't have to have any cost there. You can still get that per diem rate. Chris, what's the name of that publication? How do you differentiate what the per diem rates are? Is there I think there's an IRS publication number you can look at.
So it's the U.S. General Services Administration that publishes this. There's an IRS publication reference to it, but if you just Google 2021 per diem rates, it'll come up. These are common knowledge. So
perfect. So check that out. We'll put some notes down below, maybe after this is done, to MileIQ and that specifically. So that's a good question. Junkman from Arkansas says the information is key. I'll be referring back to this a lot. Awesome. I don't see the question there, but that was fun to throw up on the screen anyway. Facebook user, what if a storage unit and you're unsure of how many units you are purchasing? So let's say you paid $100 and it's for X number of inventory, and this is now an algebra problem where we're trying to find X. So do you have to count every single book and say, hey, I had 11 keepers and 983 bad ones, and then spread it out from there?
No, you spent $150 on 11 keepers, right?
Yeah,
in this example.
Yeah,
and,
so that's actually a pretty good methodology for saying we should actually just assign the cost to the winners, because that's gonna be a heck of a lot easier.
Yeah.
Steven, another hook for next week. How do we handle sales tax on book purchases? Tune in next time to hear your friend Ryan talk about this. We will get to this next week. Good news is Amazon is doing this for us in nearly every state now. Bad news is there's a few states they're not. And we'll talk about that a little bit as well. Chase Lock 15 says, what if you book a business trip flight with points? Don't do it. You're not going to get a deduction.
Yeah, you got to spend money, right? Yep. In order to deduct something.
Yeah, so don't save your points for personal trips, spend money on the business trips. Another fun fact, and I think this is still the case, if you have a rewards credit card and you use it for business, the rewards points, let's say you cash them out or use them for a plane flight, that's not considered a taxable asset or benefit, is it?
No, not specifically. And I would imagine that this will end up being litigated at some point, because there's a lot of people making a lot of money here. But if it is points, right, that's not taxable income. If it is cash, then it's reported as other income. So points are great. Cashback rewards are reported as other income there.
So get points if you can. Or again, people, I fall into this sometimes too. It's like, well, I don't want to take the income because I don't want to pay the tax. Well, you're still making more income than you're paying in tax. Like, it's still money. If I gave you $100 and said you have to give 50 of it back, would you take the $100?
Yeah,
probably. Now you could complain about the 50 you're losing, or just view it that you just got $50.
Yeah.
All right, a couple more questions here. And if you guys have them, post them. If you happen not to catch us live and you want to post questions, I do get a notification. The beauty of YouTube is it shows back up in my email. So I will answer you. It might be a couple days because I'm busy catching up on my accounting anyway, but I will answer at some point. So if you have questions, by all means, drop those in. Steven says, in a small business, how do we track cost of inventory? Beginning inventory plus purchases and then minus ending inventory? Do we do this monthly? Do I need to keep track of the books purchased? Basically, how do we kind of make sense of cost of goods sold?
Yeah, so the answer to that is yes, Stephen, right? And so whatever you do it consistently. If you're out hustling and you're picking up books weekly, great, track it weekly. If you're doing things quarterly or monthly, that's fine. Just do it consistently across the board. Your equation works well, right? So whatever you started with, plus whatever you bought, minus whatever you sold, and then whatever you got left. That's your inventory.
And again, shameless plug, the tracking spreadsheet, if you use the listing spreadsheet, Accelerlist, ScanLister, you can actually put those costs in as you list. It actually assigns the accurate cost to the accurate books, and as they sell, it'll help you expense those. So there'll still be an ending inventory that you have to do, and the tracking spreadsheet actually has that for you. You can just pick any date, December 31, 2020, for example, and it shows you the cost basis that you still have unsold in inventory. And of course, you can just expense it out on the income statement as well. One more from Steven. He's got some good questions here. When I purchase books to sell, is the sales tax on the purchase deductible as an expense?
Yes, but if you're I guess you should be looking into kind of a wholesaler's license so you can bypass that whole obstacle. Because if your intent is to buy books and then sell them, you should skip that middle step of paying sales tax on something and just impound it and pay it on the end.
Yep. But if you don't have that, or it's awkward to pull that out at Goodwill and hold up the line and say, look, I'm not the end user, I shouldn't be paying sales tax, just consider the sales tax as part of cost of goods sold and move on. The effort to track that separately and go back and try and deduct or credit certain aspects of it's probably not worth the headache.
Yeah, it just goes into your basis.
So just include that, and then you'll get to essentially just squeeze it out after it sells.
Yep.
This is a good one. We won't get into all the basics, but Tom W says, I just opened a Florida LLC. Kudos to you. No state income tax, sir. About to switch operations from personal to business. So you're making the leap. Sounds like things are going well. How do I reconcile what I did as an individual seller and I save all my expenses, track cost of goods sold, etc.? So how do you like tell the IRS, hey, this was my personal bank account and all of a sudden it's business? Do you have to do anything separate there?
No, and it's good you're tracking expenses and cost of goods sold and everything else. It's a muddy year. This is just kind of part of it. Hopefully you're doing it now in January. That's way better than doing it in August. But just put together a spreadsheet, use Caleb's spreadsheet or something and just say, all right, these came out of the personal bank account, and the 11 remaining months it came out of the business account.
Perfect. Simple Life, again, a really good name. Is there a limit on the per diem rate? For example, if you travel twice a week over 80 miles to one source, would you get 104 per diem rate? So 52 weeks times 2 a week. Can you get the per diem if you don't stay overnight?
Yes. So certain aspects of it, right? So there's a travel component of it. There's a meals component of it as well. And then remember, you get a half rate on the first day and the last day of any of these trips, and so you need to factor that in as well. So your math of $104 per diem payouts, it's a little skewed, but the general concept of everything is okay.
Yeah, so talk to a CPA. Make sure you got a good strategy for that one. Kind of explain the situation, and they'll kind of interpret the guidelines and help you come up with a good rate as well. We're getting some interesting ones. A couple more questions. We'll go for another 3 to 5 minutes, and we'll cap this right at an hour again. If you leave your day job and go sourcing after work, do you use your workplace as the starting point for mileage? You mentioned leaving the home office, but this is sourcing after leaving my day job. So what does that look like? I drive 10 miles to the office, and then on the way home, I go 2 miles out of the way, but I still had to drive the rest of the way home.
I wouldn't even mess with it, to be perfectly honest, right? That gets really ugly when you've got essentially multiple offices, and ultimately the IRS wants you to start your trip at a business location and end it as a business location. And when one of your business locations is your other job, things just get really, really weird.
Would it be, let's say you could actually map it out if you wanted to go to this effort. Again, we're talking 55 cents a mile. And if it's 2 miles out of your way, you're saving, $1.10 times 33%. It's not really worth the effort. But if you could map that out and say, look, round trip from, home to work to home is 10 miles, and home to work to the thrift store to home is 12, you could certainly deduct 2 miles, right?
Absolutely. Absolutely. And that's the biggest thing, right? And so audits, reviews, questions from the IRS, they aren't scary unless you're doing something shady. And so that's why we're always sitting back, and it's just be able to articulate it, just be able to defend it and stay consistent with it. So when somebody says, hey, where'd you get this number? Oh, well, this is what I did, right? And this, and this, and this, and that's how I got my 2 miles worth of a deduction.
Yep. And if there's a reason for it, and as long as you're consistent and you've tracked it or logged it, you're pretty much going to be typically on the safe side of things.
Yep.
Cool. All right, one more question. Johnny Moynad, I'm going to slaughter it. Moynadaho. We'll just go with Johnny. Does the tracking spreadsheet account for books that we dispose of from FBA where the price tanked? First off, who's tanking the prices? Just kidding. We're not going to get into price fixing. That's a hairy subject. Yes, it does. So if you dispose of books or you retrieve them, you can have them shipped back to you. So remove them and then ostensibly use them for personal use, give them away, donate them, use them as coasters or fodder for your fire. I don't know. Either way, once you've disposed of it and said it's no longer used in my business, you get to deduct it, and the spreadsheet does account for that. There's a removals report. So it kind of tracks the whole inventory cycle, including items that Amazon loses or reimburses you or get returned. It kind of handles everything in that vacuum ecosystem that is Amazon. Isaiah, an interesting question. I'm going to crowdsource this one. What do we think of the new Amazon CEO, Andy Jassy? Will he be a net positive or net negative for third-party sellers? Well, Mr. Jassy, if that's how you say his name, I believe comes from the AWS or the cloud division side of Amazon. So he's going to be more focused on the actual part of Amazon's business that made them lots of money when the physical products was not. Now they happen to be making money both ways, but the cloud certainly props them up. He's going to be more focused on that, and the software side of Amazon is just my take. But realistically, and again, I'm not going to get into politics, but the president of the US only has so much power. Whether you like him or her or hate him or her, they're only going to have so much power. And the Congress and the way that our country's been going for so long already kind of has its own company or country corporate policy and feel. And I don't think anything's going to change overnight. So I'm not real worried. Bezos is sticking around for a little bit, and I don't think there's going to be a huge change one way or the other as it relates to that. But comment below if you guys have comments on that or wonder how that may impact things. Let us know. Chris, you were so still there. I thought you actually had just frozen.
Oh yeah, no.
Perfect. And Diane Mashburn says, so I can write off meals when freeloaders come visit me in Arkansas and we talk business. Yeah, if you're paying, Diane, I think she's talking about me and Avery are trying to come down and visit. If you're paying, you can absolutely write that one off. We'll talk a lot of business while we're down there. Johnny says it was Mo in Idaho, so I apologize. Mo, what's up, Johnny Mo? And cool. And then real quick, we'll let Chris give one last plug on the way out. As a new LLC in PA, Pennsylvania, can I use Chris as an accountant?
Yeah, absolutely. We've got clients throughout the country. We're happy to help. So feel free. My contact information, I think, will be in here somewhere. Yep. And we're happy to talk.
Perfect. And we'll just shout that out. So Chris, how do people find you if they'd like to either ask a question? Again, you're available for consulting. He's pretty friendly too. If you have a quick question over email, by all means, reach out.
Yeah.
He'd love to earn your business. He has my business. I speak very highly of him. He has, Matthew, my business partner's business, and we refer to a lot of booksellers. He can operate in all 50 states and Puerto Rico.
Sure.
But any of the states, if you operate in the U.S., he can help you and assist. It is getting dark in here, but how do people find you, Chris?
So the website is fidelistaxandaccounting.com. So it's a long domain name. So if you can use that, my email is dcwinans@fidelis.tax. And we're happy to talk with you guys.
Perfect. So there it is on the screen. Fidelis, it means faithful. Fidelistaxandaccounting.com, as Steve Rakin would say. And you can check that out. Drop him a line. Say you saw this webinar, and he will take great care of you. So from all of us, meaning me and Chris and I, thank you for watching. Thanks for spending an hour of your precious time with us. We hope that you found it helpful. We hope that this will save you lots of money. We're supposed to say it. Matthew tells me I'm supposed to say it every time, but hit that like button, like and subscribe, tell your friends, try and drive some traffic. I make a whopping $200 a month off YouTube. So let's get that to $205. That'll keep paying for some golf. At any rate, thanks for your time. We will catch you next week for part 3 of our riveting accounting session. Have a good night.
Thanks,